Ever feel like tuning out financial news?
Ugh.
Interest rates this, inflation that. It's enough to make you want to just, like, close the app, you know? But what if I told you those headlines, the ones that seem kind of blah, 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 those actually hold the key to understanding what's going to happen to your wallet? That's what we're talking about today.
Yeah, we're really diving deep into how changes in those interest rates, the ones that always seem kind of distant, how those actually like directly hit your spending, especially if you've
What?
got a mortgage or if you're thinking about getting one.
Exactly. And to help us crack this code, we're going straight to the source. Some seriously fascinating research, and get this, it's from the Bank of Israel. They've been looking at how these shifts in interest rates are impacting how much people are spending.
And what makes this research so cool is it's built on data from the entire Israeli mortgage market.
The entire thing.
The entire thing, which is huge GE. Most studies only get to look at a tiny little sliver.
Right. So before we get to the really juicy stuff, let's make sure we're all on the same page here. We'll be talking about adjustable rate mortgages, or ARMs for short. These are those mortgages that, well, they've got a little bit of a, surprise factor baked in. Because the interest rate, it can actually change. And that means, you guessed it, your monthly payments, they can suddenly go up. Ouch. Right.
Yeah, and that is where our Israeli case study comes in. So ARMs, they're way more common over in Israel than in, well, some other places. And get this, their central bank, they recently went on a bit of an interest rate hike spree.
So they basically handed researchers this like perfect real-world experiment to see how those rate hikes, how they mess with everyone's finances.
Yeah.
I love it when that happens. Now, you might be thinking, okay, sure, higher rates, mortgages get more expensive. Yeah, I get it. But the real story here, it's way more interesting than that. All right, so we're like financial detectives here. We've got our magnifying glasses out. We're poring over this data from the Bank of Israel. What they find out about how those rising rates, how they actually played out in the real world.
So get this. When those interest rates went up, right, the folks who had adjustable rate mortgages, the ARMs, they actually started tightening their belts more than the people with the fixed rate loans.
Yeah, makes sense.
And here's the kicker. The more of their mortgage, like the bigger the chunk of it that was tied to those fluctuating rates, the more drastically they had to cut back.
A double whammy. Rates are going up, and it's hitting you even harder because more of your mortgage is on that roller coaster.
Exactly. And here's where the research goes from like, oh, that's interesting too. Whoa, hold on a second. They were able to actually put a number on this.
No way.
Yeah. So for every 1% increase in that policy rate, the one the central bank sets, someone with, say, a 100% adjustable rate mortgage, they could have seen their spending drop by, get this, an additional 3.6 to 4.5% compared to someone with a fixed rate.
That's huge. That's not just skipping your morning coffee. That's putting off a big purchase, maybe even dipping into your savings.
Oh, absolutely. It can snowball into all sorts of financial decisions.
Right.
And there's another layer to this that's, well, it's both fascinating and a little bit unnerving. This whole impact, it didn't happen overnight. It took some time to really kick in.
Oh, interesting. A delayed reaction.
Yeah, exactly.
So it's not like people see those interest rates going up and they immediately go into panic mode.
Yeah.
It's more like, what? They're hoping it'll just magically work itself out.
Well, yeah, you hope for the best, right?
Right.
And then, it doesn't. Anyway, the research found that the impact really hit hard toward the end of that whole rate hiking cycle.
So it's like this slow burn. Okay, so we've seen how rising interest rates, especially for those adjustable rate mortgages, can really put the squeeze on people's spending. But here's where this research, it goes from interesting to genuinely insightful, because it's not a one-size-fits-all kind of thing.
Right. Different folks, different situations.
Exactly.
And this is where the study really digs into the nuances, right? How different groups, how they react. They found that lower and middle income households,
The ones who are probably already stretching their budget pretty thin.
yeah, exactly. Those folks, they're the ones who had to make the biggest spending cuts when those ARM rates went up.
Makes sense, right? Less wiggle room in the budget. Those interest rate hikes, they hit way harder.
Exactly. And, it wasn't just about income levels either. They also found that people who, their mortgage payments were already a big chunk of their income.
Yeah.
They felt it more too.
It just amplifies everything.
It's like a sensitivity thing. Less flexibility equals, more vulnerable to those economic, those shifts.
Yeah. It's like those interest rate hikes, they're like a magnifying glass, right? Inequality. The folks who are already kind of struggling, they feel the heat even more. And it makes you wonder, like, about the bigger picture. If you've got these groups who are constantly having to tighten their belts more when rates go up, what's that mean for the whole economy?
That is the question, isn't it?
Right?
This research, it kind of gives us some fuel for that conversation because it backs up what a lot of economists have been saying, that these adjustable rate mortgages, they make monetary policy way more powerful.
Oh, interesting.
When a central bank, like, hikes up those rates, those folks with the ARMs, they're really feeling it.
So we got to be careful, those central banks.
Yeah, they're trying to steer the ship. But with all those ARMs in the mix, it's like they're working with a more, responsive gas pedal.
And let's not forget that delayed reaction we were talking about, right? How people don't flip out immediately when rates change.
Right. Adds a whole other layer of, complexity to it all.
It's like they're conducting an orchestra.
Yeah.
But some of the instruments are like split second behind. Tough gig.
It really just shows you, economic policy. It's not just numbers on a screen. It's about real people and how they react.
It's about behavior, right?
Exactly.
I love that. And that's why this whole deep dive, even though we're talking about Israel, it matters for all of us, wherever you live. It reminds us to pay attention. Those interest rate moves, they might seem kind of distant, but they're probably messing with your financial landscape more than you realize. So next time you see those headlines, you're about to just be like, ugh, whatever, remember this conversation. You might find some surprising connections.